Every pilot I know has been flying along and in seconds hits clear of turbulence. I know I have. The turbulence hits, the ride gets uncomfortable, every instinct tells you to do something, anything, to make it stop. But training and experience kick in, and you monitor your instruments and ride it out. Investing is exactly the same way. This is Captain Pierce. Welcome back to SkiesCapital. Think clearly, invest better. The market shakes, the headlines get loud, your portfolio drops, and suddenly every instinct you have is screaming at you to act. Here's the problem. That instinct, that one that feels like survival, is often the most expensive mistake a long-term investor can make. Today, on day 7 of our 30-day series, we are talking about the one thing that separates investors who build real wealth from the ones who get shaken out at the worst time. It is called volatility anchor. Let's go. So what exactly is volatility? Here is the simplest definition. It is the principle, the thesis, your conviction that keeps you steady when the market goes through turbulence and stops short-term noise from driving long-term decisions. Think about what I do in the cockpit. When flying in rough air, do I abandon the flight plan? I do not turn the airplane around because the ride got bumpy. I trust my instruments. I trust the plan we built before we ever left the gate. Your investment thesis is your flight plan. Your understanding of the business is your instrument panel. Your patience is your hands on the flight controls. Put those three things together, clear thesis, focus on business quality, and patience, and you have a volatility anchor. Without it, every bad week feels like a crisis. With it, most bad weeks feel like noise. In my opinion, the biggest misnomer in investing is the volatility is risk. Volatility is not risk. Permanent loss of capital, that's risk. Selling a great business at the worst time, that is risk. A price that moves around is not the same thing as a business that is deteriorating. And here is the line I want you to remember today. Volatility is not the enemy. Losing your anchor is. Now let's talk about why this matters. Because it is not just a mindset exercise. There are 4 real practical reasons every long-term investor needs a volatility anchor. Number 1, it protects you against panic. Every experienced airline pilot I know, when things go bad, the first thing you do is sit on your hands. You evaluate before you react to your situation. Same with volatility. Volatility is an emotional trigger. When prices drop fast, fear takes over, and fear makes us do things we would never do if we were thinking clearly. A real anchor, a thesis you build before the market gets rough, gives you something to hold on to when emotions is pulling the hardest. Number 2, keep your flight plan intact. I have never changed a flight plan because the ride got rough. Short-term turbulence is not a reason to change course. Your anchor is what tells you the difference between a rough patch and a reason to actually reconsider the plan. Number 3, it improves your long-term returns. This is not a philosophy, it is math. Take a look at this chart. And here's a number I want you to remember. JP Morgan Asset Management looked at a $10,000 investment in the S&P 500 over a 20-year period. Investors who stayed fully invested turned that into over $70,000. An investor who missed just 10 best trading days under 35,000, cut in half. Missing 20 best trading days, you're down to $17,000. Missing 30 best trading days, you left with only $7,000. And here's the part that should stop any market timer cold. 7 of 10 best trading days in the market over 20 years occurred within 2 weeks of the 10 worst days. Read that again. The best days cluster right next to the worst days. That means if you panicked and sold during the sell-off, you most certainly missed the recovery too. The investor who bailed out during turbulence were sitting in cash on some of the best days the market ever had. The anchor investor does not have that problem. They stay on the plane, they ride it out, and they capture the returns the panic investor gave up. Number 4, it sharpens your decision making. When the market is selling off, the anchor investor asks a better question. Not should I sell, but did anything actually change? Is the business weaker or is it just cheaper? That one question asked calmly is worth more than any market prediction. Now we get to the checklist. And if you know me, you know I love a good checklist. Pilots do not skip the pre-flight. Investors shouldn't either. When the market gets rough, run through these 4 questions before you do anything. Question 1, is the investment thesis still intact? Not is the stock down, not are people scared. Is the core reason you own this business still true? Is it still generating strong free cash flow? Is management still executing? Is the competitive position still sound? If yes, you have got your answer. Hold course. Question 2. Is this noise or a real thesis change? This is the most important filter you have. A bad week on Wall Street is not the same as a broken business. Separate those 2 things. Did the earnings quality decline? Did the balance sheet weaken? Did something structurally change? If the honest answer is no, it's turbulence, not a reason to change course. Question 3. Valuation becomes more attractive. Here is something I want you to think about. If you love the business at $50 a share, why are you scared at $40? A price drop by sentiment and not fundamentals is not a warning sign. It might actually be an opportunity. An anchor investor sees that clearly. The panic investor misses it completely. And this is where they sell a spectacular business at a cheap price. Question 4. I am focused on the flight plan, not the turbulence. Long-term investors should be measuring performance in years, not days. A week of rough air rarely changes a 5-year thesis. Do your pre-flight work. Trust your instruments. Keep your hands steady. Now let's talk about what it looks like when the anchor is slipping, because this is where most investors get hurt without even realizing it. Warning sign number 1, you're reacting to price, not evidence. If you're about to sell and the only reason is the stock is down, stop. That is not a decision. That is a reaction. Decisions follow business evidence. Reactions follow the ticker. Know which one you're making. Warning sign number 2. You have forgotten why you own it. If I asked you right now in 2 sentences why you own a particular stock and you cannot answer, that is a problem. Not because the business is bad, because your anchor is already gone. The thesis has to live inside your head before the turbulence starts, not get invented after it's over. Warning sign number 3. You are watching headline news more than you're monitoring the business. I have seen this in so many times. People are tracking every market comment, every Fed statement, every tweet from some financial talking head. That is not how you build wealth. Business performance, management execution, valuation, those are the instruments. Headlines are just weather and noise in your head. Warning sign number 4. You feel urgency to do something. This one is flying on borrowed time. That sense that you have to act, that something needs to happen, is almost always volatility talking, not your thesis. When you feel this urgency most strongly, that is usually the moment to slow down the most. It's time for you to sit on your hands like us airline pilots do. Now let's flip it, because this part matters just as much. Here is what it looks like when your anchor is holding strong. Positive signal number 1. You can still explain your thesis in the plain language. Right now, during volatility, you can say clearly, I own this business because it has a durable free cash flow, strong balance sheet, and management that has earned my trust. 2 sentences. Clear? That is your anchor holding. Positive signal number 2. Volatility feels like opportunity, not a threat. This is the mindset shift that separates experienced investors from everyone else. When you see a business you understand drop 15% and no real fundamental change, the anchor investor's first thought is not fear, it's interest. A good business at a lower price is more compelling, not less. Positive signal number 3. You are asking the right questions. Did the business get weaker or just cheaper? Is this a short-term issue or structural change? Those questions sound simple, but asking them calmly while everyone else is reacting emotionally, that is cockpit discipline. That is the edge. Positive signal number 4. You are focused on what you can analyze, not what you cannot control. You cannot control what the market does tomorrow. You can analyze whether this business earns real money, allocates capital wisely, and has a durable position in the industry. Anchor investors stay in their lane. They work the instruments in front of them. So here's the bottom line. The market will test your conviction regularly. That is not risk to manage around. It is just part of flying the course. What matters is whether you build your anchor before the turbulence starts. 3 things I want you to take from today. Know your thesis. If you cannot state it clearly right now, you do not have an anchor. You have hope. And hope is not a strategy. Separate the noise from the signals. Not every headline matters. Not every down week means something. Most of what you see and hear during volatile periods is turbulence, not structural damage to a business you own. And stay instrument rated. In aviation, instrument rating means you could fly when there's zero visibility out. You trust the instruments, not what your eyes think they see out the window. Disciplined investors do the same thing. They trust their processes when the market makes it hard to see clearly. That is the real anchor. This has been Captain Pierce with SkiesCapital. Think clearly, invest better. This has been for educational purposes only, not investment advice. I'll see you on day 8.